Joining us now, Meghan Shue, Wilmington Trust Chief Investment Strategist. And Meghan, I'm going to cut you some slack. Wilmington Trust, a lot of trust there. Got to have a lot of trust in what you're doing. So I just think you probably have a more conservative overall viewpoint of how to manage money for people. It's got to be there, obviously, when you're at Wilmington Trust. But this is what got me. Our economic and market views have become more instructive, and we think it's an appropriate time to move to a modest overweight to equity risk. So all through this, we've been talking about the new highs again and these ridiculous outsized gains for the quarter. So through all of this, you haven't been overweight. You've just been market weight?
Yeah, we've been fully invested. And if you think about the first quarter, we were really pretty sensitive to some downside risks to the economy, most notably the labor market. And I was probably on here at some point talking about private payrolls, ex-healthcare being in contraction in the first quarter. And we have never seen that outside of a recession. So this is another time where this time is different, but that was not something that we were willing to stick our necks out on. And outside of the real AI plays, we did see some weakness on the economic side. And now we've got the labor market reaccelerating. So we were fully invested through that, but now we think it's appropriate to be overweight, mostly because we have some of this headline risk around the war receding. And I think the second half of the year might not see the narrow, supercharged gains of the market, but we think equities will outperform fixed income in over the next 12 months.
Well, what does fully invested mean at a shop like yours? Is it you mean no cash? You could be 100% bonds. Is that fully invested, or so you weren't fully invested in equities because now you're getting more invested because you're going to a modest overweight?
It means a benchmark weight to equities. So depending on what your risk tolerance is, that might be 70% into equities. That means we had 70% in equities. Not sitting on excess cash, not sitting on excess defensive access like investment grade fixed income, for example. Okay,
so do you remember what it was? Was it 70? And where will it go now? What does a modest overweight mean?
So it depends on how the client, like what their goals and their risk tolerance is, but just take a 70-30 risk profile. Yes, that means that we have about 74% in equities, a little bit, the opposite of that. So, 27% in fixed income. And we've diversified it across large cap, small cap, and emerging markets, where large cap has had a lot of gains, but small cap has also done very well. And another reason why we've turned more constructive is that we do have a more dovish outlook on the Fed, where we think the Fed is going to be cutting rates this year, not because of weakness in the economy, but more because of disinflationary trends. And that should be very good for small cap and also emerging markets being an area that's obviously had a tremendous amount of AI momentum as well.
Right. So at this point, if you had to pick Dow, S&P, NASDAQ, is the Dow where you're like a Wilmington Trust is more focused, or you're ready to roll the dice on it's the Mag 8 now, people say?
Well, we did deploy that within large cap. We kind of split it between growth and value. We have a slight overweight to growth in our portfolios, but also recognize that if the economy is holding in pretty well and we get that dovish Fed value, probably have a good year. So I think you want to be diversified, and there's parts of tech. It's a very complicated landscape. There's parts of tech that have done incredibly well, like the memory names and semiconductors, but there's also other parts of tech like the Mag 7, as you've noted, that have underperformed. So I think there's opportunity there, and we don't want to be putting all the chips in one basket.